Chapter 11, Part 2, Changes in Estimate, Add-ons for Tangible Assets, and what happens when you make a mistake. Well, it depends. So, other issues in dealing with tangible assets is what happens if you decide that you're going to keep it longer or shorter, or the salvage value changes. Just remember that this is considered a change in estimate and is treated prospectively, which means you don't go back and change anything. You look to see what's the net book value to the point of the change, and that amount less salvage value is the new depreciable base divided by the remaining years. So here is our example. In 1991, we completed a $2 million building that had a useful life of 40 years and a $60,000 salvage value. Then in 2001, we did an addition for $500,000, which had a 30-year life and a salvage value of 20 years, not changing the original 40-year estimate. It's just now we have 30 years on this. And then in 2019, it's determined that the probable life of the building and additions will extend to the end of 2050, or 20 years beyond the original estimate. So now we're saying that for the building, it would be 60 years, and for the addition, it would be 50 years. So let's take a look at what all this means. All right, if we're using the straight line method, we're going to compute the depreciation that would have been charged from 1991 through 2000. And the salvage value is 60. We paid 2. There's 40 years. It was at the beginning of the year, so we get 48,500 as our annual depreciation. Now, let's compute the annual depreciation after we had the addition. So we still have our 48,500 over 40 years, and for 30 years we've got the addition, so now we have a total depreciation of 64,500. Now, do we need to go back and change anything because of our revision of our estimated life in 2019? The answer is no, because this is a change in estimate and we do not go back and make retroactive changes. So, in order for us to figure out the new depreciation starting in 2019, we have to look at the net book value for the building and the addition. So, we take what we paid for the building less 28 years of depreciation to get a new net book value. We subtract our salvage value, which didn't change, and now we have a new depreciable base, and we're going to divide by the remaining 32 years, which is 60 minus 28 that we've already done. So now we have a new depreciation rate of 18,188 for the building. Now we're going to do the addition. We're going to take the 500,000 less the 18 years worth of depreciation. We get a new net book value. We subtract our salvage value. We have a depreciable base. We're going to divide by 32. And now our new total annual depreciation is going to be 24,188. So that's how you do when you have a change. Now let's take a look at what happens when you have to correct errors. Well, here's the rule. If you have an error and it affects a prior period, you have to go back and restate. And any changes would be adjustments to beginning retained earnings in the year you find the error. So in this case right here, we bought a truck in 2014 for $30,000 with a 5-year life, and we traded it on July 1st for a larger truck with a value of $40,000 and a 5-year life, and we paid the dealer $22,000. The transaction had commercial substance, but the journal entry to book this transaction was they only booked the cash portion of the transaction. So now what do we have to do in 2016? All right. If it's January, the first thing we need to do is what was the accumulated depreciation on the old equipment? Well, here's the thing. Since we didn't make an adjustment, the only thing that would have been on the books is for that first year of 2014, because we wouldn't have done anything for at the point of sale. We would have just done our normal $6,000 at the end of the year. So let's take a look at this first. We would adjust retained earnings for a loss on this transaction. We would take the old equipment off the books, which was just for the 1 year. And the new equipment, we would book the additional $18,000, which is the difference between the $40,000 and the $22,000 they booked. Now, what do we have to do to adjust our accumulated depreciation for 2015? We're going to go, the old equipment was $6,000 a year, which is booked in 2015, and the $22,000 would have been for half a year, so what we booked incorrectly was $8,200. What we should have booked is $40,000 divided by 5 times half a year is $4,000, which means we have to adjust accumulated depreciation and retained earnings. Now, again, since this is a prior period adjustment, it does not affect the current year. We go back and restate the financials and adjust beginning retained earnings. Now, let's look at this in terms of T accounts so you can show what the effects of all this. Now, we would have had our old equipment on the books at the point of the sale, but instead of recording the sale, all we did was add $22,000, and at the end of the year, we booked $8,200 in error for depreciation. So this would have, we would have booked everything incorrectly. So that gave us balances of $52,000 in equipment at the end of 2015 and accumulated depreciation of $14,200. Now let's do our adjustments. We'll take the old equipment off the books, which is the $30,000 and the $6,000 for the 1 year, because we never booked the half year. Then we're going to correct the new equipment. We're going to add the $18,000 to bring it up to $40,000, and we're going to reduce the depreciation booked in error. And now when we get done, we notice that now our equipment account has $40,000, which is correct at the beginning of the year, and we have a half a year depreciation for that new equipment. Now let's take a look at a correction of an error that happened in the current year. So we purchased a truck for $18,000 in January 2012 with no salvage value and 5-year life, and we sold the truck for $3,500 on January 1st for $3,500 with the following entry. They just booked cash and truck. It is December 31st and no additional depreciation has been booked. What should the correction be? Well, first of all, we have to determine the depreciation of the truck at the point of sale. So it would be $3,600 times 4 years. Then let's do our journal entry, which is, it should have been, we booked the cash of $3,500, took accumulated depreciation off the books, took the old truck off the books, and booked a loss of $100. That's what it should have looked like. Now, the other way we could have done it is reverse the incorrect and book the correct. Or just adjust the difference. Either way would have been fine. And that is the end of Chapter 11. Now we move to Chapter 12.